Good morning from cool and cloudy Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, September 21st, 2025. In today's podcast, our focus is on the S&P 500's current 38% rise from the April lows and how to make sure that if you were fortunate enough to buy the break this year and to re-engage the market somewhere around the April lows, that we're able to keep most of this advance and get it in the bank before the inevitable correction starts. I also want to begin by offering a little perspective on investing. Everybody wants to beat the market. A lot of the new people that we work with, both on the research side and also on the managed account side of our business, talk about beating the market like it's a minimum expectation for investing. It is not. It's extremely difficult, if not rare, to be able to consistently beat the market, especially if you're using risk control like we are. Keep your drawdown smaller, to keep the volatility in your account smaller. This year, stock market managers are largely underperforming passive benchmarks, especially in the equity markets, despite a volatile environment, that if you're using some kind of a risk control methodology, would allow you to avoid some of the drawdown and be able to buy the market back after the drawdown at a better price. As of mid-2025, about 2/3 of active managers failed to outperform their benchmarks. This continues a long-term trend in which the majority of active funds fail to beat passive index funds after factoring in fees. By using strict risk control, we have been fortunate enough to capture most of the rally off of the April lows while missing about half of the decline from the February highs. Now our focus is on making sure that we can keep most of it, because we're going to get a correction here. We don't know when it's going to happen. Nobody knows, but it's going to come. Before we get started and look at some of our latest research and charts and models, here's just a little bit of info about us. Asbury Research is a registered investment advisor. We're an RIA, and we've been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have two levels of research available. We have our Asbury Premium for more serious investors, which includes the latest updates on all of our data-driven models and some personal instruction on how to implement them into your portfolio, which we do via Zoom. We also have our entry-level Substack newsletter, which I'm going to right now. It's $25 a month, does not include any of our trading models, but does have selected portions of the premium research product. And we also have a model there, which we're going to look at a little bit later, that's called the STORT report, that looks at a broad spectrum of different asset classes and tells you where the opportunity lies. There's also a free version of the service. So if you like our videos and our approach to markets, strongly suggest that you sign up for the free version of this Substack. It's asburyresearch.substack.com. And you could sign up right there. It's a no-brainer if you're already tracking us. It's just going to give you more stuff to look at. Again, asburyresearch.substack.com. We also offer managed accounts for both individual investors and financial advisors. Get back to our landing page. Financial advisors as a third-party manager. We're actually starting to do a lot more business in this area, and would be happy to schedule a quick Zoom with you to show you our 4 model portfolios, how they work, how they're performing. There's 4 different levels of risk reward encompassing the 4 model portfolios, and see if they might be a good fit for you or for your clients. To do that, you go to the contact tab, ask for a Zoom meeting, and we'll send you a link to that, and you can pick a date and a time that's going to work for you. Now, let's go to some of our individual topics. Managed account performance. This is real money being invested. Let's change views. And through the end of last week, year to date, 3 of our 4 model portfolios are outperforming the S&P 500. Asbury Aggressive has outperformed by the greatest amount. So what we have here is this is a daily chart that goes back to the inception of our 4 model portfolios, which is the middle of 2018, late June of 2018. And we've got 4 different lines here. The first line that is down here at the bottom is the S&P 500. And then in green, we have the Asbury Conservative. And then in blue, we have Balanced. And up here, we have Asbury Aggressive. So this just, for perspective, this is how our models have looked over a long-term period by hypothetical backtesting. But this is real time this year. So all of the data that I gave you real time from this year is all accurate. It's all up to date and based on real trading. The next thing we're going to look at is some of our models that you're probably more familiar with. We're going to go back here, change views, go back to the website, and we're going to go to the correction protection model, or the CPM. CPM this year, trailing the S&P 500 by less than 1%, but with less than half the maximum drawdown, a 6.7% lower standard deviation, and a much lower beta. For those that are familiar with these terms, maximum drawdown is from the peak of your account or the peak of a model or the peak of the market, if you're following the S&P 500, all the way down to the bottom. So from February to April of this year, that would be the maximum drawdown in the S&P 500. It's right around, it's exactly 18.9%. A strategy with a lower standard deviation indicates smaller price swings and a narrower range of possible returns, implying more consistent returns and lower risk. A strategy with a lower beta suggests a more stable investment, one that is less volatile than the overall market, which generally speaking is the S&P 500. This means the price is less likely to fluctuate wildly. It makes for a good choice for investors who prioritize stability and lower risk, which is primarily most of our clients. So next thing we're going to do is, we always talk about drawdowns. Let's look at why these drawdowns are important. I'm going to change views again, and we're going to slide down here and look at the CPM year-to-year drawdowns since 2018. So in 2018, the S&P had a 19.8% drawdown. CPM only drew down 15.10. Some of these drawdowns are small. If we have a small drawdown in the S&P 500 for the year, we're going to have usually a smaller drawdown, but not as dramatic. You can see in 2019, S&P drew down 6.8, CPM drew down 4. Here's when it matters. COVID, the S&P drew down 33.9%. That was basically late January, early February of 2020, all the way down to March 27th of that year. The S&P drew down just under 34%. CPM only drew down 9%. What does that mean? Well, if you're actually drawing money out of your RIA, if you're retired and you're starting to take money out, you take a big hit like this and you're also drawing money out every month, that's going to really change your expectations for how long your money's going to last. Here's another one here in 2022. S&P drew down by 25.4. CPM only drew down by 20.2. This year, S&P drew down by 19%. CPM only drew down by a little over 3. Here's why it matters. If you're going to draw down 20%, you need to make 25% back the other way just to get back to where you were. If you draw down 30%, which is close to what we saw for COVID, COVID was actually 34%. Draw down 30%, you need to make 43 back the other way. Let's say we're up so much this year already in just a few months. Let's say we draw down by 40. You got to make 67% back the other way. And again, if you're compounding the drawdown with the money that you need to take out for your living expenses when you're retired, that could cause a real problem with how long your money's going to last. So basically, all CPM is a completely data-driven, dynamic stock bond allocation model. It was designed to be an alternative to if you use an advisor. A lot of people will put you in some variation of a 60-40 stock bond portfolio. This was meant to be a dynamic version of that, where rather than what your advisor told you 3 years ago to be in 60-40 or whatever it might be, we use the market to tell us when we should be in stocks and when we should be in bonds. It makes a lot more sense to me. Let's go back, change views real quick, and go back to CPM. So you can see CPM has been risk on right here since April the 24th. This chart goes back 2 years, and it shows that it does a pretty good job of finding the bottoms and getting you out of the market when there's danger. Like when we went to risk off on April 15th here, this model can't see the future and nobody else's can either. So we don't know if this drawdown is going to be 2 weeks or 2 months, but we get ourselves out of the market when the internals tell us to, according to our model, as we did a couple of times here earlier this year. And once we buy at a little bit better price, as long as the internals stay strong, we stay with the market. So we've been with this now since April the 24th, and that's where we're going to begin next week. Next one we're going to look at is our sector rotation model, our SEAF model. So let's go back to the research center. Again, this is the password protected part of our website. Go down to SEAF. So this is our SEAF model. SEAF model has outperformed the S&P 500 year to date with a lower max drawdown, a lower standard deviation, and a lower beta. Since inception in mid-2018, SEAF has significantly outperformed the S&P 500 on an annualized basis with a significantly lower maximum drawdown and a similar standard deviation, a similar beta to the S&P 500. SEAF, all SEAF does is we built a model that measures the velocity of money moving around the 11 sector spider ETFs, which if you put them together, it's the S&P 500. And we did it in 3 different time frames across the top here. And by a scoring system, we're always invested in the top 3 with the money fastest going into those sectors. So this week, XLK, XLC, and XLF, technology, communication services, and financials is where we're going to be invested as of the opening on Monday morning. And the ones we're avoiding are healthcare, consumer staples, and utilities. What do these have in common? They're all defensive sectors. What do these 2 up at the top have? Or these top 4, they're generally all the risk-on sectors. So the model is very much skewed towards more performance. The money that's moving around the S&P is skewed to higher prices for this rally from the April lows to extend further. The next thing we're going to look at here, changing views again, we're going to go to the Asbury 6. The Asbury 6 is a daily indication of what the internal health of the market is. We do this by looking at the 6 different metrics. We use a rate of change, volatility, volume, market breadth, and others to tell us what the real health of the market is. Like when you walk into your doctor's office, he may watch you come in the door and your hair's combed and you have nice clothes on. He may make a initial assessment of what your health may be. Then he sits you on the bench and he starts to check your pulse and your blood pressure and your reflexes and listening to your heart and your lungs. That's what this is for the market. 4 or more of these that are green indicates a positive bias. It's been positive as of August the 12th. Here's how it's done over since August of last year. You can see it's a lot more active than the S&P or than the CPM. The CPM is typically 3, or the CPM historically going back to 2017 annualized about 5 round turns a year, 5 in and outs, 5 risk on to risk offs a year. This is about 10, but it's meant to be sensitive. We want it to be sensitive. Again, it's updated every day in the research center after the close, and it's meant to keep us on the right side of the market during these days when you walk in the morning and the market's down 70 and you're long. You don't know what to do. Should you get out? Is this just going to be a move that's going to last a day or two? This is what we use the Asbury 6 for. So it's a daily driven gauge of the U.S. stock market's real internal health according to these metrics that we back tested to see that they work well with each other. Let's go back here to the chart. Scroll up to the front. What we're going to show here is here's the A6. Scroll one more over here. And then eventually, okay. This is the Asbury 6 daily since inception, Q4 of 2017 in green, along with the S&P 500. You see it tracks with the S&P 500 very well. The difference is it's mostly higher than the S&P 500. And because this is more active, the drawdowns are smaller. The maximum drawdown that the A6 has had in these 8 years, 8-year look back, has been 13.7. Again, versus 33.9 in the S&P, which was during the COVID period. And we did the math on this. This is through the second half of, actually, this is through September the 18th. This is just through a couple of days ago. 85% of the time, the Asbury 6 in green is outperforming the S&P 500, which is in blue, again, with a substantially lower drawdown. So this isn't meant to be a tradable model, but because of the low drawdown and you don't mind the extra activity of 10 round turns a year on average, this is a way to participate in the market with a lot less risk. Let's go back now and look at some charts and look at some of the things that we're paying attention right now to. So we're going to go to the research center and we're going to move down to keys to this week, which is our weekly. We basically probably look at 100 charts, 120 charts, something like that. And we pick the charts out that we think are the most germane to what's going on in the market now. So let's look at some of these. And again, this was just written at the end of last week. So let's start with chart number 2. This is the NASDAQ 100 versus the S&P 500 down at the bottom. Relative performance. The NASDAQ and secondarily the SOX, which is semiconductors, they typically lead during a healthy uptrend in the stock market. So since April the 25th, which was a day after our CPM went back to risk on, NDX started outperforming the S&P 500, started underperforming in the middle to latter part of August. Right here, the market started to lose its mojo. It started to lose its leadership. Look what's happened since September the 12th. Starting to outperform again. That's a good sign for the market. We don't know if it's going to last a week or a month or whenever, but right now we had a little bit of a slump here in the latter part of August and we're starting to recover from that. That is good news for the market. Here's the SOX index that I talked about. Relative performance started outperforming the S&P 500 on May 9th. Here's that August 28th to September period, starts to slump. It's holding resistance up here and it's starting to slump. Look what's happened since September the 8th. It's outperforming again on a 63-day basis, which is a business quarter, and is also broken out to brand new highs. Another good sign for the market, as incredible as it may be because we've gone up so far so fast. Let's look at another one. Most of the strength this year has come from the Mag 7. Everyone talks about the Mag 7. Here's the Mag 7. Since March, here's Mag 7 down here in the lower panel versus SPY with a 21-day moving average also on that chart. What this is saying is since April the 24th, again, April the 24th is when CPM went back to risk on for different reasons, but you can see how well that the Mag 7 has been outperforming the S&P 500 on a 21-day basis since then. It's tested this 21-day moving average a bunch of times, and now it's making new highs. The MAG 7 itself is making new highs here. So the leadership that's been responsible for most of the strength here is still persisting. The next thing we're going to do is let's go back to the Research Center, and we're going to look at some of our ETF ideas. We put out ETF ideas when we see a special opportunity. So we're in the Research Center, our ETF trade ideas, and here are the current ideas. You can see them up top. So we bought RING, which is the gold miners, on August the 8th. Said we were looking for new all-time highs. This is the protective stop. It's moved up numerous times since then, but since August the 6th, it's up 26%, and it's outperformed the S&P by 20%. We initially put this idea on because we wanted to have some kind of quote-unquote hedge against the S&P 500 peaking and turning lower, because we've got all this stuff going on with tariffs and interest rates and all the geopolitics that surround those things. So this has not only been a good hedge for us, but it's also been an outperformer. You can see that we added to that by buying GDX on 9/11. We've got a lead there, and we've also bought the metals and mining XME, which is up 11 and has outperformed the S&P 500 by 8%. Again, we've been bullish since April. Wanted to make sure that we had some coverage, and we were looking for something that would be a good tool for that. Generally speaking, gold, when the stock market is strong, gold goes higher. But when the stock market turns down, oftentimes you'll also get some strength, and they'll start to diverge. What I'm trying to say is that linear correlation between gold and the S&P 500 when the S&P is going up is generally significant. They're both moving the same way. When the stock market starts to go down, oftentimes money comes out of the stock market and goes into gold. This is just based on statistics and looking at various correlations, linear correlations. So this hedge is on. It's still in place. We think it's a good place to be. GDX actually broke out to new highs about a week ago. So this move can still have legs. Finally, let's take a look at our sort report. Before it began, Asbury 6, CPM, and C for all part of Asbury Research's premium research service. Contact us via the contact tab at asburyresearch.com to get information about service details and also how much it costs. Finally, let's go back to our Substack. That's the $25 a month one. And look at our sort report, which is a part of, again, our entry-level Substack online newsletter called Chart Focus. The service is $25 a month. Again, there's a free version. There's a Substack link for this if you go to asburyresearch.substack.com. The sort report, which we're going to go there. Here's our sort report here. This is our latest sort report. It tells us which parts of the global market have positive trends, are outperforming their benchmarks, and have positive asset flows. Trend, relative performance, and asset flows. There it is, a little bigger. Which means that new money is pushing in and pushing the price of the ETF higher. There's new assets coming into the ETF. This is a low-cost way to cover a lot of territory and make better decisions that are based on data, not opinion or economic forecasts. So we cover gold, emerging markets, U.S. technology, small cap, crypto, U.S. equities, global equities, X the U.S., interest rates, commodities, crude oil, and the U.S. dollar. You can see right now, 4 of these are green all the way across, which means they're checking the boxes for trend, relative performance, and money flows. They are gold. As mentioned, we've been in gold for a couple of months. We're making lots of money there. Emerging markets, technology, and small cap. Those are the places on this broad sort report quantitatively that our clicking on all cylinders, and according to the numbers, that's where the opportunity is heading into next week. So we had a long one today, but this is going to wrap up our latest Asbury Research Following the Money podcast. Our next Follow the Money is tentatively scheduled 2 weeks from today on Sunday, October the 5th. I hope to see you then. In the meantime, if you have any questions, want any information on any of the research models or model portfolios we looked at today, you can contact us right here at asburyresearch.com via the contact tab. Don't forget to like and subscribe. And I'm going to go watch football now. Have a great Sunday, and we'll see you in 2 weeks.